My name is Dave Jones, and I have the privilege of serving as California's Insurance Commissioner, where I lead the Department of Insurance and regulate the largest insurance market in the United States, where insurers collect over $300 billion in premiums from us annually. And today, we're gathered to make two important announcements. First, we'll be releasing the claims data for the Carr Fire and Mendocino Complex fires. This is the first opportunity to share with the public the claims figures and insured losses stemming from those two destructive fires. We'll also be updating the data we had previously supplied on the 2017 fires. And the second important announcement is today we're releasing a new report prepared for the Department of Insurance with partners that will walk through, importantly, the nature of the climate-related risks that insurers and Californians face, some of the challenges and opportunities associated with those climate-related risks, and the impacts and things we're doing to address those impacts here at the Department of Insurance. Our wildfire history, unfortunately, tells us how our fire season has changed over time. We've gone from a fire season of 3 or 4 months now to a year-round fire season, with the most damaging fires coming in the fall and winter. Over the past 2 decades, the frequency and severity of wildfires has increased, causing significant property damage and tragic loss of life in the wildland-urban interface areas of the state, but also in areas that were traditionally thought to be at lower risk of fire, like Santa Rosa. Of the approximately 13.6 million housing units in California, which are represented across 8 to 9 million actual properties, there are an estimated 3.6 million housing units in the wildland-urban interface. These are the areas of high brush, high forest, where the wildlands interface with urban areas. More than 1 million of these 3.6 million homes in the wildland-urban interface have been rated by insurers as facing a high or very high risk of wildfire. Due to drought, climate change, tree mortality, and other factors, wildfires have unfortunately become a way of life here in California. First, let's go to the figures that we're releasing with regard to the Carr and Mendocino Complex fires. These were tremendously devastating fires that destroyed more than 900 homes. As you know, these fires are contained now, but fire experts and fire officials tell us that traditionally the worst and most destructive of California's fires have occurred after September 1st. In fact, if you look at CAL FIRE's list of the 20 most destructive fires in California's history, 17 of those have occurred after September 1st. So while we've already had 2 very destructive fires, and we're going to release the claims figures associated with those, the worst may well be yet to come based on past history and experience. So with regard to the Carr Fire and the Mendocino Complex fires, it's important, I think, to note that the Mendocino Complex fire has already eclipsed the Thomas Fire of last year as the state's largest on record, burning more than 451,000 acres. The Carr Fire in the Redding area is now the 7th largest fire in California history in terms of acres burned, at more than 229,000 acres, and it also ranks as the 6th largest fire in terms of the number of structures destroyed, 1,604 to date. Now, the figures I'm releasing today are based on our survey of insurance companies. These are not estimates. These are actually figures based on claims that have been filed with the insurance companies. These numbers are likely to grow as the insurance companies process claims and as additional claims are filed. But based on the claims data that we have currently for the 2018 fires, the widespread destruction from these 2 wildfires resulted in damaging or destroying more than 8,800 homes, 329 businesses, and more than 800 private automobiles, commercial vehicles, and other types of property. More than 10,000 claims have been filed And the grand total of the insured losses associated with these two wildfires in 2018 is $845 million. Now, again, these are based on the most recent and available information. This is the first time we're making public these figures. We anticipate these numbers will grow as the claims themselves are processed. So that now takes me to updating the figures for the 2017 fires. Last year, the tragic major wildfires in both Northern and Southern California caused 43 fatalities, completely destroyed more than 7,000 homes and businesses, and partially damaged another 50,000 homes and businesses. Also, we had the mudslides in January of this year. So with regard to the 2017 wildfire insured losses, the most recent data we have now for those losses is that the confirmed insured losses are more than $12.8 billion. That's a slight increase from the last time that we released figures. For the 2018 Montecito mudslide insured losses, again, these mudslides caused a terrible and tragic loss of life. The insurers reported 152 total residential losses, 1,597 partial residential losses, 11 commercial property total losses, 347 commercial property partial losses, and 851 total claims for personal and commercial automobile losses and other types of losses not accounted for in the figures that I've already given you. Here too, as these claims are being processed, we have updated figures to share with you. So suffice it to say that sadly, wildfire is a year-round experience in California. The most destructive fires have traditionally occurred after September 1st. The fire experts tell us that the next couple of months we could see additional fires with additional catastrophic losses. We thought it important to provide you with this information so that you would have the best available information that the department has with regard to the scope of loss associated not only with the 2017 fires, the 2018 mudslides, but also more recently, the 2018 fires. Now, with regard to the Mendocino Complex and Carr fires and the other 2018 fires, we have moved very aggressively to help consumers and fire survivors in the wake of these fires. This includes deploying our consumer services personnel to the areas of the fire, to staff local assistance centers, to be on hand to help people with claims processing. I've gone and personally visited the burn areas, met with fire survivors, met with local officials, made sure insurers were on site processing claims, made sure that we had adequate staff on site to help consumers. I also issued a notice to insurers asking them to expedite claims by cutting through red tape and making available certain funds under the insurance policies immediately. For example, I asked they provide immediately 4 months worth of what's called additional living expense coverage. That's the coverage to cover your out-of-pocket costs associated with lodging, transportation, food, and clothing when you're forced from your home. I also asked the insurers in this notice to begin writing checks for 25% at least of the personal contents coverage in the home insurance policies, again, to get money into people's hands so they could begin rebuilding their lives, starting to replace important personal belongings. And I asked that the insurers do so without forcing people to complete a burdensome inventory. We've also asked they speed payments for vehicles that have been damaged and also provide leniency with regard to paying premium when your home has been totally destroyed. The first thing on your mind might not be going through your mail to make sure you get the premium bill paid for within 30 days. Most of the insurers have agreed to comply with these requests. We continue to work on those that have not. I've also issued a declaration of emergency situation. That's necessary under the insurance code in order to enable insurers to move staff in from out of state to help adjust claims. Given the enormity of the Mendocino and Carr fires, we thought it important that we give the insurers every opportunity to make sure they had staff on hand. I've also been very careful to remind the insurers in the context of allowing them to bring staff from other states that it's important that they make sure those personnel are trained on California's consumer protection laws. In the 2017 fires, we had a handful of complaints from fire survivors that they were being told things incorrectly under California law by insurers. We remedied that with a very quick notice to the insurers, notifying them that it's their responsibility to make sure that they accurately cite California law, give the fire survivors their options under California law, and if they failed to do so, there would be sanctions. That problem, thankfully, cleared up as a result of that notice. We're trying to get ahead of that issue here by letting insurers know at the front end, again, that this is their responsibility. So I want to also add a note of caution for fire survivors. Obviously, this is a terrible, terrible time. You may have lost loved ones. Your family or loved ones may have suffered injuries. Your home may have been completely or partially destroyed. There's a tremendous emotional toll that's taken of individuals and families in this circumstance, and there's a keen desire to get your life back to normal. And we'll do everything we can to work with you and assist you in the insurance recovery process. But also know that this is a time when scam artists will also come into your area to try to take advantage of you. And you should be very careful before you sign any piece of paper from someone purporting to assist you. Make sure that any contractor that you engage to assist you with replacing or rebuilding your home is a licensed contractor. You can do so very easily by checking the Contractors State License Board website. We've also deployed our law enforcement personnel from this department. We have sworn peace officers that investigate all sorts of frauds that work for me as commissioner. We've deployed these officers to the areas that have been impacted by the fires, along with other state law enforcement agencies, to try to deter scam artists, but also educate residents about the sorts of things to look out for. There's also a class of licensee called public adjusters that we license here at the department. These are individuals that are available to help fire survivors with the recovery process. But know this, they charge you for that assistance. It's not free. And we encourage fire survivors to first contact the Department of Insurance if they're having any disputes with the insurance company. If they have any questions, no question is too small or too large for us. You can call us at 1-800-927-4357, and we're here to help. And we do it for free. We don't charge you for that assistance. And in fact, with regard to the 2017 fire survivors, we've already been able to get $50 million for fire survivors from the 2017 fires that we've assisted when they've contacted us through our hotline or through our website or met with us at the local assistance centers. So we have a very good track record. Before you hire someone to assist you with your insurance recovery, we encourage you to contact the department, work through the process, get as far as you can, and then and only then decide if you're at an impasse whether you need to pay someone to assist you. Now, next I'd like to talk about an important new report that the department is releasing today, a trial by fire managing climate risks facing insurers in the Golden State. This very important report has been prepared with the assistance of a number of partners. In a moment, we'll have a chance to hear from Dr. Evan Mills, the principal author of the report, who is an expert on climate risk. We also want to thank climate policy experts at Berkeley Law's Center for Law, Energy, and the Environment. And also I want to thank my staff in the Office of Climate Risk Initiatives as well. This important report takes a look at the impact of climate change in California, the sorts of risks that climate change is causing for insurers and Californians, principally physical risks, what are called transition risks. That is the risk that is related to a transition away from using a carbon-based economy to one that relies on renewable fuels, and the impacts of that transition on particular investments, and in particular investments in fossil fuels, and then liability risks. These are all risks that are being driven by climate change that insurance companies, other components of the financial sector, and the overall economy are facing. So the report walks through those risks, provides a very important discussion of the nature of those risks, their potential impacts in California, the challenges and the opportunities associated with those risks here in California. It also describes some of the important things the Department of Insurance has been doing to encourage insurers to recognize those risks, take steps to address those risks, as well as things we're doing to make sure that we do everything we can to make sure that insurance continues to be available throughout California, including in areas where there's a high risk associated with wildfire. Now, the climate scientists and climate experts tell us that climate change is a contributor to severe catastrophic weather events. We know in California we've seen an increase in severity and frequency of wildfire. We can also anticipate sea level rise, additional flooding, more droughts. These are the sorts of physical impacts of climate change that are a part of our future and our present here in California. So joining with me today to announce the new report is its primary author, Dr. Evan Mills, who's a principal with Energy Associates. He'll be joining us on the phone. And also standing with me is Ted Lamb, Research Fellow at the University of California, Berkeley School of Law, Center for Law, Energy, and the Environment. So at this time, I'd like to turn the floor over to Dr. Mills, who's on the line. And then after that, I'll introduce Mr. Lamb. Dr. Mills.
Thank you very much. Well, first, let me again thank Commissioner Jones for his foresight and his really expansive work on the climate change issue throughout his many years in office now, and for making critical data available to the public and to researchers. The data you just heard, it's really very important. It's refreshing to have policymakers like the Commissioner who rely on science in their work. It's essential to addressing this broader problem. Thanks also to the rest of you for taking time today and come over and hear about this project. I've spent a couple decades myself looking at the intersection of climate change and insurance, both from inside the scientific community as a researcher contributing to the United Nations Intergovernmental Panel on Climate Change, you might know as IPCC, and also to the U.S. National Assessment Process, which has also taken up the question of insurance and climate change in the U.S. context. And I've also had interesting collaborations more directly with the insurance industry and its regulators and professional associations. So it's been very, very interesting process as a researcher. So let's turn to the report. It's really become abundantly clear that the insurance industry is a canary in the proverbial mine shaft when it comes to climate change, with an important difference, because unlike some helpless canary, the insurance industry can actually help society, confront the climate problem. And I think this is the highest level takeaway from the report. I want to go a little deeper and amplify what Commissioner Jones just said about how climate change impinges on the insurance industry. There are the three ways that he mentioned: property loss, litigation, and investment. And what I want to add to that or reinforce from that is that this three-pronged vulnerability transforms climate change into what investment analysts like Moody's and others call a systemic risk for insurers, because here you have simultaneous and correlated economic damages that can all occur together, and they can significantly compound one another and make financial impacts larger than any one of them could do individually. On the property side of that triumvirate of issues, our report takes an in-depth look at California, and it shows how seemingly unrelated consequences of natural disasters in recent years are tied together through climate change. And the main example that's relevant to today's meeting is how drought dries accumulated fuels, that lays a path for fire that's fanned by elevated temperatures, and then that fire strips hillsides of soil-retaining vegetation, which can set the stage for mudslides during subsequent severe rainfall events, which themselves are climate-related. So to put a finer and kind of more specific point on this, the state's recent drought was the worst in 1,200 years. 1,200 years. And it ended with a period of devastating intense rainfall, ironically, that built up this huge base of flammable grasses and other vegetation in the state. And then the fires that commissioners just described just last year were the worst in recorded history. And literally on the heels of these fires, the so-called Pineapple Express storm that came all the way across the Pacific like a train made landfall in Montecito immediately on the heels of the Thomas Fire down there. And that was a 1 in 200 year event, resulting in what was probably the costliest mudslide in the state's history. So torrential rains boost the growth of fuels, which allows this cycle to repeat again. And that's part of the climate change regime that we're all facing here in California. It's certainly not the only climate risk, but it's one that's very front and center right now. So I want to end on a high note, and to me it's an important high note. And one thing that's unique about this report is that we don't just describe the problem, if you will, but we also look at what can be done and what is being done within the insurance industry and around that industry to be more proactive and get in front of this issue. So I think it's really encouraging that as the Earth's climate is changing, so is the business climate. And the good news is that there are a lot of win-win solutions that are in reach for insurers and their various industry allies, climate modelers, brokers, and so on. And many of these are being demonstrated in practice. They're not just pie-in-the-sky hypotheticals. So not only are insurers today looking at how to improve resilience, which is kind of the response you'd expect first, the closest to how we all expect and hope insurers will approach risk, but they're also focusing on the underlying greenhouse gas emissions that drive the problem. And an example of that is in this whole space of green buildings, where insurers who are looking closely at this are finding that they are more disaster resilient. And dozens of insurers have actually developed innovative products and services that capitalize on that. On the kind of supply side, so to speak, of energy, renewable energy is a lucrative investment now, free of a lot of the market risks, the transition risks that the commissioner mentioned and that are discussed in great detail in the report. Renewables are free of those risks that are, however, facing coal and other fossil fuels. And we've identified, and it's outlined in the report, a remarkable $60 billion in investment by insurers around the world in that arena. And that's ongoing. And then lastly, related to insurance, we're seeing California insurers divesting of so far about $4 billion, just California insurers, in fossil fuel investments out of enlightened self-interest. And in doing so, they're demonstrating new best practices for managing climate investment. That divestment has been spurred by, again, the California Department of Insurance's Commissioner Jones' initiatives on that front to bring these risks to the attention of insurers and help quantify those risks through a novel stress testing project that was done this year on the investment side. So that wraps up what I would like to share with you today. Take a look at the report. It has a concise executive summary. And let me turn it back to the Commissioner. Thanks very much for your time today.
Thank you very much, Dr. Mills, and really appreciate your bringing your tremendous expertise to bear as a principal author of the report. And it's been a great privilege for me and my staff to have a chance to work with you on this. And this report, as I said a moment ago, makes an important contribution to a better understanding of the sorts of risks we face, but also challenges and opportunities related there too. Next, I want to introduce Ted Lamb, a co-author of the report. Ted's a research fellow at the UC Berkeley School of Law, Center for Law, Energy, and the Environment. Ted.
Thank you, Commissioner Jones. As the Commissioner mentioned, my name is Ted Lamb. I'm a research fellow at the Center for Law, Energy, and the Environment at UC Berkeley School of Law and a co-author of the report. The Center for Law, Energy, and the Environment is an energy and environmental law and policy think tank based at the School of Law. The report is here. Trial by fire is an important step in California's leadership on climate policy. As the Commissioner and as Dr. Mills have already discussed, the report documents the risks facing California and the entire insurance industry due to climate change, and the measures insurers and regulators can take to protect all Californians. As California continues to craft innovative policies to fight climate change, leaders across the state will need resources and solutions for managing these climate risks. And from our perspective at Berkeley, at the top of the list is ensuring that all facets of the state's government and economy are pulling in the same direction. Moving forward, it will be essential to continue to integrate insurance policy and climate policy, as CDI and Commissioner Jones have done for the past 8 years. Since the report has been described in so much detail already, I would just like to say that the Center for Law, Energy, and the Environment is truly proud to contribute to this landmark effort and applauds lead author Dr. Mills, the Department of Insurance, and Commissioner Dave Jones for their initiative in tackling this pressing issue. Thank you.
Thank you very much, Ted, for your tremendous contributions to the report and also for Berkeley Law's Center for Law, Energy, and the Environment and your colleagues' participation as well. I also want to acknowledge and thank the director of our Office of Climate Initiatives, Aaron Ezraj, who's here, and his staff for their hard work on the report as well. So this makes, as I said, an important contribution to a better understanding of the nature of the risks faced by California, in particular by the insurance sector, and the challenges and opportunities associated with climate change for California and for the insurance sector. The release of this report, I think, is particularly timely, given that here in San Francisco, the governor is convening a global climate action summit, which is bringing leaders from throughout the world together here in San Francisco to take stock with regard to the progress that has been made, but the progress that still needs to be made in taking action with regard to climate change. And very excited to be able to participate as a speaker at a number of the conferences going on during the summit, at which we'll have an additional opportunity to present the findings of this report. Finally, I think it's important that we note, as I said a moment ago, the worst may be yet to come. And by that, I mean specifically with regard to wildfires. Our history has been that the most destructive of the wildfires in California occur after September 1st, but also the worst may be yet to come with regard to the physical impacts of climate change, whether it's additional drought, sea level rise, flooding, and other associated impacts. We're simply not doing enough fast enough to get ahead of this problem, and that's going to be a topic of conversation at next week's summit. To add a further emphasis, as you're probably all too well aware, 2 more major fires have erupted in California and led to mandatory evacuations in the North State. The Delta Fire, which is a fire that's broken out just north of Redding in the Trinity National Forest. Remember, again, Redding was severely impacted and significant parts of it destroyed by the Carr Fire. The Delta Fire has led to mandatory evacuations, and it threatens hundreds of structures, and the fire itself has grown to 15,000 acres. The second of these fires that are currently burning is the Hertz Fire. This is also burning in the Trinity National Forest. It's burned more than 46,000 acres and led to the closure of several recreational areas and campgrounds. So far, no structures have been lost, no lives have been lost, and firefighters have reached a containment level of 75%. But this is a reminder that the month of September, October, November are months in which, sadly, historically, we've seen even worse fires, more destructive fires, and greater losses, which means we need to redouble our efforts to get in front of this problem. And here at the department, we're doing everything we can to contribute to doing exactly that. So with that, I'm happy to first take questions from anybody in the room, and then we'll go to those that are on the conference line. Yes, please, and maybe identify yourself, and then I'm happy to take your question. So that's what we call in the legal world a compound question, and I'll do my best to answer each and every part of it. First, I anticipate that the next commissioner will continue to move forward with the Department of Insurance's leadership role in addressing climate risk, both as it relates to the insurance sector in California, but also nationally and internationally. We have been an international leader. One of the things I'm very proud of having done is having formed an international working group of insurance regulators from across the globe to share best practices and approaches with regard to climate risk. The title of that group is the Sustainable Insurance Forum, and it's doing some great work. And I anticipate that the next commissioner will continue that international work as well as being a national and state leader in addressing these issues. Under my commissionership, and I would anticipate the same will be for future commissioners, we're doing everything we can to encourage insurers to continue to write insurance in areas that face a high risk of wildfire. The legislature has passed laws that give the insurers the discretion to decide where and when to write home insurance, and also if they suffer significant losses and can justify the need for rate increases, by law, they're entitled to rate increases. And so we are seeing in the last 10 years an increase in non-renewals of insurance in the wildland urban interface areas. We're seeing an increased utilization by insurers of models to assign fire risk scores to individual homes. We're seeing some insurers in some of these areas of the state declining to write new insurance for homes because the insurers have concluded the fire risk is too high. And I anticipate we're going to see more of that and more rate increases. The insurers, as we said a moment ago, suffered $12.8 billion in insured losses from the 2017 fires and mudslides alone. And that problem is only going to get more acute. Now, I've issued a report earlier this year in January on wildfire insurance availability and pricing challenges. In that report, I made a series of recommendations to the legislature as to how to get ahead of this problem before it becomes a crisis. Sadly, none of those proposals have been taken up by the legislature. I hope the legislature in the future does take up those proposals. One of the proposals, which goes to a subpart of your question, is simply to require the insurers to file the models they're using to assign risk scores and permit the department to review them and approve them. Why is that important? Well, we've discovered that the models that the insurers are using to decide not to write insurance for homes don't incorporate the things that homeowners are doing to mitigate the risk of damage to their home from wildfire, whether it's using roofing materials that are impervious or protecting the eaves of the home or having defensible space. The models don't take into account the very things that fire officials are telling people to do and people are doing to try to protect their homes, nor do the models take into account things that communities are doing to make their communities safer from wildfire. That's a major disconnect and a huge frustration for homeowners. So we're recommending, among many other things, that those models be filed with us. We have a chance to review them and approve them to make sure the models reflect what's actually happening on the ground. So as I said, we've made a series of recommendations. We're hopeful the legislature will take those up. I anticipate that the next commissioner will continue to engage on these issues because the problem is growing and the nature of the risk is growing. And while we're not in a crisis yet, all of the trajectories are in the wrong direction. I say we're not in a crisis yet because, to put it in perspective, while this is a very acute problem for certain areas of the state, in counties like Tuolumne, something on the order of 89% of their homes have been rated high or very high risk by insurers. Over 1 million homes, as I said in my remarks, have been rated as high or very high risk. And even though we've seen a 15.3% increase in non-renewals between 2015 and 2016, that doesn't mean that those 15.3% people couldn't find insurance. Most of them found insurance. They're finding it from another admitted carrier. They're finding it on the surplus lines, or they're going to the FAIR Plan. The FAIR Plan is the insurer of last resort. It was established by the legislature some 50 years ago to write fire insurance regardless of the risk. They are the canary in the coal mine. To the extent that we saw FAIR Plan policy counts go up dramatically, we would know that means people can't find traditional private insurance or surplus lines insurance, so they're having to go to the FAIR Plan. What's the policy count right now? About 33,000 in the wildland urban interface, about 33,000. That's versus some 8 million insured properties in California. So most people are still finding insurance, but an additional number of people are going to find it harder to find insurance. More homes are not going to be written by insurers. The price of insurance in these areas is going to go up. Insurers are very rational economic actors, as we would want them to be, and they're taking into account the losses that occurred in 2017, the fact that those fires burned areas that were thought to be of lower risk, wiped out whole neighborhoods in Santa Rosa, for example. And so areas that have been traditionally thought to be of lower risk are going to be re-rated as higher risk, and insurance is going to be tougher to find in those areas. Not a crisis yet, but the trajectory is in all the wrong direction. So I have no doubt that the next commissioner will continue to be very engaged on all of these issues, just as I have. See if there's other questions in the room. Yes?
Kind of took this under away. I was about to
Hi.
With homeowners are seeing the non-renewal, are you finding it's happening more with recent fires, or is it, how far is it dating back? And the reason we ask is we recently did a story, we're hearing from people in the Oakland Hills who went through the firestorm in 1991, but they're getting non-renewal notices for their insurance as well.
So, as I said a moment ago, this is a phenomenon that's been growing over the last 10 years. It's getting worse. And so the best available data we have is comparing 2015 to 2016 and looking specifically at the wildland urban interface counties, the some 25 or so counties where they're heavily forested or a lot of brush. And in those counties, we saw this 15.3% increase. I would anticipate that year to year, we're going to see even more non-renewals, and that's going to spread from the wildland urban interface areas into more urbanized areas that have also historically suffered from fires, like the Oakland Hills, the Berkeley Hills, Sonoma County, Napa County, areas of those counties that are more urbanized are now understood to be facing a higher risk. And as a consequence, some insurers are deciding they're not going to renew. Some insurers are deciding they're not going to write insurance. So I think the problem is going to grow. That's a real challenge for the individual that suffers that problem. And I don't mean to minimize the challenge for them and the challenge that people are facing in some of these more rural counties. It's quite challenging. But in a broader context, understanding the number of homeowners that have been forced to go to the FAIR plan to get fire insurance, which is the fire insurer of last resort. It's a nonprofit. It writes only fire insurance, basically, and it's been set up by the legislature to do exactly that. If you can't find insurance on any other traditional or surplus lines market, there's only about 33,000 policies. Now, that's bad news for those 33,000, don't get me wrong, but there's 8 million other homes that have been insured in one way or the other. And so getting worse, but not a crisis yet. And that's why I've made some strong recommendations to the legislature about what we need to do to get ahead of this before it becomes a crisis. And sadly, the legislature has not picked those proposals up. Other questions in the room? Yeah, please. Sure.
I'm sorry, I walked in late. You may have already addressed this, but one of the things that we heard out of Napa and Sonoma County after the fires in 2017 was that some of the homeowners, some people were specifically State Farm, were hearing that they were having to actually recoup their losses. They were having to give very detailed, specific line-by-line inventory of the things that they lost, and they were having a lot of stumbling blocks to that end to recoup their losses. What is being done about that?
So just about every home insurance policy written in the state of California has a requirement in it that the homeowner inventory their personal contents before the insurer will pay coverage for personal contents. I recognize that when you've lost everything, your home, 40 or 50 years worth of your possessions, you're displaced, it's asking a lot to prepare a detailed inventory of every stitch of clothing, every piece of furniture, every utensil, every wall hanging, everything that you might have collected in 30 or 40 years of living in that home. So what I did in the case of the 2017 wildfires, and have again done with the 2018 wildfires, was I issued a notice to the insurers asking that they issue checks of at least 25% of the personal contents coverage without requiring an inventory. In the 2017 fires, what I did in addition was issue a second request to the insurers that they issue at least 75% of the personal contents coverage without requiring an inventory. Many of the insurers did that. Some went as high as 100%. Some insurers declined to do it. The State Farm was one of those insurers that continued to insist that their policyholders fill out, in most cases, a detailed inventory. The law doesn't give me the authority to order them to waive the inventory. We had a bill that we sponsored this year that was carried by one of the North State legislators that would have given the insurance commissioner the authority to waive the inventory requirement in the event of a declared disaster like that which befell the North State and portions of the South State last year. The insurers killed that bill in the state legislature. So the current law as enacted by the legislature is that insurers can require these inventories. I do everything I can within my existing power to ask that they not require the inventory in the face of these enormous disasters. We've had quite a bit of success at getting many insurers to do that, to issue more of the money without the inventory. But sadly, some insurers continue to insist that the inventory be filled out. Other questions in the room? Operator, let me see if there's any questions from those that are on the phone line.
Ladies and gentlemen, if you wish to ask a question on today's call, please press star, then 1 on your touch-tone phone. Our first question comes from the line of Julia Piper with Green Tech Media. Please go ahead.
Hi, thank you for taking my call. I have a two-part question, both related to utilities. The first one for Commissioner Jones. How do the insurance numbers you released today factor into the potential liabilities for insurers? Is there any direct link there? Do these numbers inform what utilities could be on the hook for, depending on how other assessments go? Part 2 for Dr. Mills is, can you talk a little bit more about how the insurance industry is thinking about the risks for utilities, both in addressing wildfire and then maybe favorably thinking about decarbonization? I know some big questions, but would appreciate your insight.
So let me start with the first half of the question. And yes, the insured losses that are being paid out by the insurers related to fires where a utility was found to have caused the fire does have implications for the big debate that occurred in our legislature this last month with regard to whether the liability standard imposed on utilities ought to be reduced. So CAL FIRE found at least 14, maybe as many as 16 of the fires in the North State were caused by equipment or lines or other equipment of PG&E. The current state of the law is that if the utility causes a fire, the utility faces liability for the damages resultant from that fire. That includes a right of an insurance company to take the losses it's paid out to homeowners who lost their homes or cars or businesses associated with the fire, and then turn to any damage award that's been made against the utility and seek to recover some portion of that damage award to repay the insurance company. The legal term is subrogation. So the insurance companies, when they pay out to the homeowners for losses associated with fires that might be caused by a utility, retain the right to basically stand in the shoes of the homeowner to obtain a portion of whatever recovery is obtained from the utility to cover the insurer's losses. So needless to say, the insurance industry was opposed to the proposal the legislature took up to weaken the liability standard for utilities, because weakening that standard would have direct implications for the insurer's ability to recover. In my view, it also would have had direct implications for rates and insurance availability if that liability standard had been weakened. Thankfully, the legislature declined to change the liability standard, so the liability standard stays in place. They did, however, enact legislation here in California that will allow the utilities to issue bonds, the proceeds of which can be used to pay for damages that they might be liable for as a result of causing the fires. And the bonds debt service, subject to approval of the Public Utilities Commission, can be paid for by ratepayers. That was very controversial, but the utilities asked for that concession because they argued that they were facing considerable economic duress. Ratepayer groups and others were adamantly opposed to that, but that did pass. Let me also say that the legislature also passed some legislation increasing the standards visited upon utilities for fire prevention. In addition, the legislature appropriated funds that will enable more dollars to be spent and enable the establishment of programs to try to thin some of our forests. We're facing a challenge with millions and millions of trees that are dead as a result of bark beetle infestation, as well as years of success historically in limiting fires, which has had the effect of allowing forests to grow significantly in ways that nature would not have otherwise allowed. So we have a lot of fuel out there. And so the legislature enacted legislation and also granted budget authority to go after some of that fuel. And then I'm going to turn it over to Dr. Mills. But one point I do want to make, though, is that, again, one of the three climate-related risks that insurers face is what's called transition risk. And that is a risk associated with markets and governments moving away from a carbon-based economy to a economy based on renewable energy, which is what all the climate scientists tell us we need to do to avoid catastrophic temperature rise. However, moving away from a carbon-based economy to an economy based on renewables has consequences for the value of assets invested in the carbon-based economy. So oil companies, coal companies, gas companies, utilities, which derive a substantial portion of electricity from the burning of fossil fuels, the underlying value of those assets could potentially be impacted if markets and governments move us away from relying on those very enterprises' extraction, mining, distribution, and burning of fossil fuels. Insurance companies invest trillions of dollars, and they do that because they take a portion of the premiums they collect from us and they put it into reserves to make sure they have money available to pay claims. A big part of my job is to make sure they have adequate reserves to pay those claims in the future. A part of my job is also, as is the job of any insurance regulator, to make sure the insurance companies are invested in ways that will retain value and not lose value, because we don't want them investing in things that will result in less money available downstream to pay claims. So one potential risk to insurance company investments in fossil fuels is this transition risk driven by a response to climate change. And so specifically, because I've looked very carefully at what's happening with regard to the coal sector, I've asked insurance companies to divest from investments in thermal coal. Why? Because I believe that thermal coal has a high risk of becoming a stranded asset on the books of insurance companies as markets, consumers, businesses, and governments move away from allowing the burning of thermal coal. I've also required insurers to publicly disclose their investments in oil, gas, coal, and utilities that substantially rely upon fossil fuels to generate electricity. Why? Because I think it's important that insurers, that we as regulators, that stakeholders and the broader public understand the degree of investment that insurance companies have in these assets, and that they and we are thinking about the potential risk to the value of those assets associated with transition risk. So that whole effort, which is called our Climate Risk Carbon Initiative, does touch upon utilities, and in particular requires disclosure of insurance companies' investments in utilities that rely substantially on fossil fuels. Let me just close, and then I'll turn over to Dr. Mills. The work that I'm doing in this regard is very consistent with what's been called for by the G20 Financial Stability Board's Task Force on Climate-Related Financial Disclosure. That's a mouthful. But the G20, in the wake of the financial crisis of 2007, 2008, set up a board called the Financial Stability Board, which is populated by ministers of finance, treasury secretaries, and central banks of the top 20 economies in the world. And this board has been charged by the G20, which is, again, the leaders of the top 20 economies of the world, to make sure that they're on top of any systemic risks to the financial system so that we don't have a crisis like that which occurred in 2007, 2008 ever again. One of the risks that the Financial Stability Board has identified is climate-related financial risk. They set up a task force to look at these risks. That task force was populated with leaders from the private sector. That task force issued a report last year which called for disclosures by companies across all economic sectors of climate-related risks, including disclosures by utilities of the risks they might face related to climate change. So what I'm doing in the insurance space is very much in alignment with what bank regulators and ministries of finance are looking at with regard to the banking sector and the financial sector generally. Dr. Mills.
Thank you. Thanks for the question. I think insurers are pursuing this issue of the utilities and wildfire risk and risk more broadly on two fronts. The first is better defining the risk, and the second is improving resilience. Kind of group it into those two buckets. On the first one, a lot of it comes down to modeling, and modeling's been discussed today, which is good. It's critical to be able to quantify and pinpoint exposure geographically and technologically, and a lot is happening in that space thanks to broader trends like more powerful computing and big data. And so some insurers are really leading the way with what are regarded as best-in-class models more broadly in grid reliability and grid disruptions. And the report actually touches on that a bit. You can look around page 60 for some examples. I think an important point to make around this is that we think about the fires and we think about the property loss, and that's real and that's large. But the other half of it is what's called business interruption, and these are less visible losses. These aren't physical property damage. These are disruptions in business activity, tourism, restaurants, businesses, you name it, and those can be a very large portion of the insurance claims and just the hardship that homes and businesses are faced with. And I want to underscore businesses. We often think about, and we see the pictures mostly of houses being burned, and again, that's very real, but the business commercial sector impacts are quite large as well. On resilience side, and these are things that forward-looking insurers are doing. Looking at the grid, looking at the robustness of the grid, looking at the incremental value of decentralized power supply, particularly renewable supply, looking at things like microgrid, smart grid, using smart meters to better detect outages more quickly and respond to them. So the notion of minimizing losses, how can insureds shelter in place when the power's out but the property is safe, and so the whole area of backup generation and energy efficiency in itself, as I mentioned before, green buildings can be intrinsically more disaster resilient. So these are areas being looked at. These are best practices. They're not typical practices. Much more certainly needs to be done and should be done within the industry, but this is on their radar, and interesting work is happening.
Operator, any other questions on the line?
Our next question comes from the line of Suki Lewis with KQED. Please go ahead.
Hi, I was wondering kind of where the complaints from consumers have been at this year. You mentioned last year that you guys have received a number of complaints about fraud issues. What kind of complaints have you been hearing so far this year, if any?
So in the wake of the 2017 fires, we helped thousands of people with insurance questions and insurance disputes, and have been successful to date in obtaining over $50 million for fire survivors that they wouldn't otherwise have obtained. It's early days for the 2018 fires. I don't have at hand specific consumer contact or complaint figures for those fires, but the kinds of things that we are hearing are not dramatically different from the 2017 fires. There are questions about one's coverages. There are questions about the amount of insurance one has. There are questions about the process. There are questions and concerns about the timing of the process. We're getting questions about the inventory that I talked about a moment ago. So I think it's early days in the claims process for the Carr and Mendocino fire. We wanted to get the insured loss figures and the claims figures out as soon as we had them, but it's still fairly early in the claims process for people. And the tougher going oftentimes doesn't occur till a bit later in the claims process when you're getting down to brass tacks with regard to how much you're going to get under your insurance policy for your structure, either to replace or rebuild or purchase a new structure because yours was totally destroyed, or to help rebuild a structure that's been partially destroyed. So it's still a bit early in the claims process for those fires. Other questions?
Our next question comes from the line of Hannah Beesing with the Press Democrat. Please go ahead.
Hi, can you hear me?
Yes.
Hi, so you just touched on my question a little bit before, but I guess I'm maybe seeking a more anecdotal perspective from consumers, from staff, from insurance companies. What are you hearing about the response to this year's set of fires versus last year's set of fires? Obviously, you guys are looking at a more devastating, monetary and insurance loss, but, anecdotally from folks on the ground, what are you hearing about the response?
Again, I think that the kinds of things we're hearing are very consistent with what we heard in 2017, with one difference, and that is so far the overall magnitude of the loss is not yet where it was ultimately in 2017. And so that has meant that there's been less stress placed on the insurers, less stress placed upon our consumer service officers, and so on and so forth. So that's the one difference. But again, I want to underscore, we're very early on in terms of where we are in the calendar. And historically, the worst has come after September 1st. So, we're doing what we need to do here to be prepared for that. I would urge homeowners throughout the state to do a number of things. One is take a look at your insurance policy, get a replacement cost estimate from your insurer, go and talk to a contractor and get an estimate of what it would cost to replace your home from a contractor. Most people mistakenly believe that what it's going to cost to replace their home is what their home costs when they buy it on the market. No, it's an entirely different value. Oftentimes in California, the cost of replacing your home can exceed the market value of the home. So you want to insure the replacement cost at a minimum and then some. In fact, what you want to do is very seriously consider getting insurance in multiples above your replacement cost level, either 25% or 50% above, because what we've seen in the context of these major natural catastrophic disasters like the wildfires in 2017 is that when whole communities are wiped out, the demand for material and supply goes up, and that causes prices to go up. And so not only should you get a replacement cost estimate and make sure that the insurance you have covers you at least for the replacement cost, but you should also get insurance in excess of that to make sure then that if your home burns down as a part of a larger disaster and there's price surge, you have sufficient coverage to cover your needs. Make an inventory now of all your belongings. Take a smart device, if you're old school, a video camera, and videotape either electronically or with real tape your belongings. And then store that on the cloud or send that tape somewhere safe outside of your immediate area for safekeeping. Then you have a visual record of your stuff that can dramatically make things easier if the worst occurs and your home burns down and you're forced to have to prepare one of these inventories that I described a moment ago. Have an emergency plan. Have a go bag of stuff you need to help you and your family live for a couple of days if you're forced out of the home. Have a conversation with your family about where you're going to go, where you're going to meet in the event that fire strikes your neighborhood or your community. Those are all things I would encourage Californians to do and do so now. Other questions?
Ladies and gentlemen, as a reminder, if you wish to ask a question, please press star 1. And there are no further questions at this time.
Okay. Again, I want to thank our partners in the trial by fire report preparation, principal author Dr. Evan Mills, co-author Ted Lamb at the UC Berkeley School of Law Center for Law, Energy, and the Environment, and my staff. We're very excited about the release of this report and its contribution to a better understanding of the risks and challenges and opportunities not only to the insurance sector, but to California writ large. And I want to thank those that have attended the press conference. And if you have additional questions that occur to you, please do give our press office a call. Their phone number is on the media advisory you were sent. We'll be happy to answer any additional questions that you might have. With that, operator, that concludes our press conference call.